Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's 137 CP program organized by AASB of ICI for this council year. As the topic is very important, NBFC, so we are going to cover the key considerations in audit of NBFC sector today. And in order to tackle this very important sector, we are having with us two learned speakers, CA Chinnaswamy Ganeshan ji and CA Rahul Singhal ji. So I welcome both the learned speakers on behalf of AASB of ICI. Welcome Chinnaswamy sir, welcome Rahul ji. We are also having with us two moderators, CA Asta Gupta ji and CA Tushar Kapoor ji. Both the moderators will moderate the webinar. Today's webinar. So I welcome both the moderators. Welcome Asta and welcome Tushar ji. So without wasting much more time, I request Madam Asta Gupta ji to please start the proceedings of today's webinar. Over to you, Asta madam, please.
Thank you, Anil ji. First of all, I would like to thank the Auditing and Assurance Standard Board of ICAI for giving me this wonderful opportunity to moderate today's panel comprising of such esteemed speakers, CA Dr. Chinnaswamy Ganeshan sir and CA Rahul Singhal. And as Anil ji had said, that today is the 137th program organized by the AASB in this council year. So kudos to the entire team for coming up with such niche topics, because NBFC is a very niche sector and it's for the betterment of the professional fraternity. So if you're anyone who has been appointed as an auditor of a non-banking financial company or is looking forward to explore opportunities in the audit of NBFCs, then today's webinar is perfect for you. You're at the right place. So I would quickly like to, speak a little bit about the NBFCs before we go on to the next part. So it is a company which is registered under the Companies Act and it is required to be registered with the RBI. Basically, it is a company which is engaged in business of loans and advances, acquisition of shares, stocks, bonds, debentures issued by the government or other marketable securities. The operations are very much similar to the bank, but it is not bank. And I'm sure that our speakers will deliberate more on the differences between a bank and an NBFC. So everything from understanding the entity, the internal controls, audit planning, and most importantly, the differentiator between the audit of an NBFC and other entities will be covered today. If you have any questions, we would request you to drop them in the question box and that will be taken up at the end of the session. Without any further ado, let me invite our first speaker, a very esteemed first speaker for today, CA Dr. Chinnaswamy Ganeshan. A very brief introduction about him first. Sir had started his practice as a chartered accountant way back in 1988. He was in personal practice in 2005. After that, he served as a director in Lovelock in Lewes for 6 years and as a partner in BSR & Co. for 6 years with audit practice. He has handled Indian and MNCs in almost all industrial and service sectors and carried out audits, advisory on Indian international financial reporting, taxation, due diligence, and other assurance services. He is the founder partner of Messrs. Chinnaswamy Ganeshan and Company, Chartered Accountants based in Chennai, and senior partner and head of the audit and assurance of Messrs. CNGS and Associates LLP. He specializes in financial reporting, covering Ind AS, IFRS, US GAAP, company law matters, audit and taxation, and was conferred honorary doctorate for his extensive contribution to Ind AS and IFRS by a renowned foreign university, and is a recipient of the Jewel of India Award for his role in financial services and Certificate of Excellence for his contribution in the field of financial services. He has presented 1350 plus papers at various seminars, workshops, and conferences, both in India and overseas, on these specialized subjects. He has also assisted 80 plus companies on Ind AS transition and authored several books on financial reporting and Companies Act 13. He is closely associated with the ICAI for the past 20 years and is a guest faculty for all of the 5 regional councils. He was a co-opted member of the Accounting Standard Board of ICAI, Ind AS Implementation Committee of ICAI, and the AASB of ICAI. He has been advising many boards of Indian and MNCs and was independent director in some of those PSUs, banks, and NBFCs. Currently, he is a co-opted member of the Executive Committee of Institute of Directors, Chennai, Board of Studies of Department of Commerce of Shiv Nadar University, University of Madras, and Thyagaraja College, Madurai. It's an honor to have you as a speaker today, sir. Now I would like to invite my co-moderator, Tushar Kapoor, to take the session forward.
Thanks, Asta, for handing it over to me. And hello, everyone. thanks for joining the session, especially on a Monday in the month of September. I know how busy it must be for everybody. And we welcome our second speaker, CA Rahul Singhal-ji. CA Rahul is a chartered accountant and a senior partner in one of the leading and oldest firms of India, and is currently heading assurance practice in the financial sector. He has over 26 years of rich experience in the field of advisory and assurance services with clients in private sector housing finance, other financial services, manufacturing, infrastructure, consumer and IT sector. CA Rahul also comes with a diverse international experience, as throughout he has worked with international member firms, including one of the Big Fours. He's also a member of the Institute of Cost Accountants of India and holds a BCom honors degree from Delhi University. Thanks for joining us, Rahulji.
Thank you.
And as you all know, NBFCs is a regulated business, and as auditors, we need to be very diligent with performing our audit procedures. So hoping that all of you will be focused throughout the session, I hand it over to Chinnaswamy sir to start the session. Thank you.
Thank you very much for giving the opportunity of speaking on this important topic. When we were talking about the key considerations which we are supposed to look at with respect to the audit of NBFC, what I thought was, let me just look at the environment or the legal environment in which the NBFCs are operating, and the audit related appointment and other regulations which is coming in. And finally, we will have a discussion on some of the key areas of audit focus with respect to NBFC audit. Especially, we will look at the practical areas which we are supposed to look at for the audit of an NBFC. I'm not sharing any PowerPoint presentation. I'm just going through that on an example basis to ensure that we are face-to-face right from the beginning and the end of the discussion. As already mentioned by Mr. Anilji and the moderators, you can have your questions at the end of the sessions. And to start with, you know that any audit, whether it is a audit of a company or audit of a banking company or audit of even a non-banking financial services company, the first and foremost importance is understanding the client's business. That's what the standards on auditing is talking about. When we were talking about understanding the client's business, in a non-banking financial services company, the entire activity is a financial services activity that you know by the name itself is prescribing. And another thing is, it's a non-banking financial services company, and accordingly, it is not a banking company. It is carrying on certain financial services activity similar to a bank, but not exactly a bank. Accordingly, whatever we learn for doing an audit of a bank may not squarely apply in respect of audit of a non-banking financial services company. So that, first of all, we have to keep it in our mind. The NBFCs can be deposit-taking NBFCs, non-deposit-taking NBFCs. It can be just an investment company. However, the criteria which is set out for getting an RBI license under the Rule 45(1)(a) of the RBI Act is that if 50% of the income of a company is arising out of financial assets, or 50% of the total asset side of the balance sheet is comprising of financial asset, that particular company is required to get a certification under Section 45(1)(a) of the RBI Act to carry on its business, because it's considered automatically as a non-banking financial services company. That's the reason why we normally look at, even in CARO reporting, there is a specific clause which is talking about 45(1)(a). Even for a normal company, we normally look at whether these conditions are being met, and to that extent, whether it is required to be covered by the RBI Act. That's the first and foremost of understanding the business of the NBFC, which will have the basic requirement for us to commence an audit. The second important point which is required to be considered is having an understanding of the various laws and regulations relating to an entity. Again, this is coming from the standards on auditing. Unless you know what is the laws and regulations which are governing the audit of an entity, you may not know whether there is a non-compliance with the laws and regulations. And if the non-compliance with the laws and regulations will have an impact even on the going concern assumption of the entity, has to be determined by the auditors. And accordingly, in respect of a banking company also, non-banking financial services company also, we should always look at the various laws and regulations which are applicable for the NBFC. One good thing which we can have is that if you are doing an audit of a bank, maybe you might have done an audit of even branch of a banking company, to some extent you can relate or draw a parallel from that experience to do an audit of a non-banking financial services company. The reason being, the regulator in both the cases are nothing but the Reserve Bank of India. So the principal regulator is the Reserve Bank of India in the case of NBFC, like banks. And accordingly, all the notifications, circulars, etc., which has been issued by the Reserve Bank of India in relation to a non-banking financial services company should be thoroughly understood by the auditor. Otherwise, it is very difficult for carrying out the audit. As I have said that, like banks, NBFCs are also having a similar business activity. You will understand that the prudential norms, capital adequacy norms, various ratios, net worth requirement, the various rules, regulations, etc., formulated by RBI is also specifically available for the non-banking financial services company. And accordingly, the laws and regulations are one of the criteria to be looked into. A non-compliance of a particular law and regulations could make this NBFC not eligible to carry on the business of NBFC. That's the reason why we always look at the compliance with the laws and regulations. The RBI, being the regulating authority for NBFCs, regularly issues circulars from time to time, monitoring the various activities of the non-banking financial services company. An auditor doing an audit of an NBFC should always look at the various circulars which are issued and what is the latest master circular governing the requirement of audit relating to NBFC. And of course, there are other circulars which are also issued, which is for the management to comply with. As an auditor, we will only look at what is relevant to the audit. And of course, what the management is supposed to comply with, if it is not complied, what would be the impact on the going concern assumption of the entity should also be checked by the auditor. One such requirement is whether the company is having a valid certificate of registration with RBI under Chapter 3B of the RBI Act. That is what we are referring to in CAROS Section 45(1)(a) of the RBI Act, whether a certificate has been received by the company if it is an NBFC. So that is a simple check which we are supposed to look at whether the certificate is still valid or not before we commence the audit. Another important requirement for an NBFC is there is a minimum net owned funds requirement. And of course, it's a 200 lakhs, that is 2 crore, even for a small NBFC, which is carrying on its business as an even non-deposit taking NBFC. 200 lakhs is the minimum net owned funds. And there is a computation which is available to determine what is the net owned funds and how the net owned funds has to be calculated. For example, if an NBFC is having net owned funds of, let us assume, 5 crores, but out of that 5 crore, they have invested money in their group entity to the extent of, say, for example, 4 crore. Then the net owned funds cannot be 5 crore because there is a restriction which says that how much is the amount of investment they can make in the closely held company or group companies. And to that extent, there is a reduction in the net owned funds as per the balance sheet, and the net balance should be considered whether it is more than the required limit of 200 lakhs. So this is always a basic consideration for the auditor, understanding the business of the NBFC and accordingly understanding the various laws and regulations governing the requirement of an NBFC. Right? Now, having said that, the auditor will start with understanding the business, understanding the laws and regulations. The auditor should also look at whether the audit appointment is valid or it is having the proper authority before he could commence the audit. And of course, RBI has given a specific circular on appointment of auditors detailing various requirements relating to the audit appointment. Let me just take you through certain areas. This audit appointment and RBI regulations, before that, there is no strict guidelines which has been given, but RBI has brought in a guidelines for the appointment of auditors for NBFCs from the financial year 21-22. What they have done is, this particular appointment regulations will applicable for non-banking financial services company, NBFCs, as well as housing finance companies who are having asset size of 1,000 crore or more. Suppose if it is less than 1,000 crore or more, then this audit appointment and RBI regulations relating to that will not apply. In all other cases, whether it is an NBFC or it is a housing finance company, the appointment regulation should be followed very strictly. These appointment regulations prescribe some eligibility criteria. Or otherwise, I can say that to become a statutory central auditor of an NBFC, the audit firm has to have certain qualifications. For example, it says that if the net worth or net assets of the entity is more than 15,000 crore, it should have at least 4 full-time chartered accountants, out of which FCA should be 4 and 2 should be minimum CISA qualified or DISA qualified, and they should have a minimum of 18 professional staff. Professional staff means audit clerks, article clerks, or any other person who has a knowledge of bookkeeping, etc. This eligibility criteria has been made as a mandatory requirement. Apart from a normal expectations under the Companies Act, if the NBFC, naturally NBFC will get covered under the Companies Act, to that extent, whatever is the qualifications required under the Companies Act for an auditor will also apply. Whatever code of conducts and ethical requirements prescribed by the Institute of Chartered Accountants of India will also apply in respect of the audit appointment. So the audit rotation, if you look at the Companies Act, it says an audit firm can be appointed for a term of 5 years and can also be reappointed for another term of 5 years. That means an audit firm, it's a partnership firm, can continue as an auditor of a company for 10 years at one stretch. However, according to the RBI regulations, which is brought in the financial year 21-22, what happens is, in respect of NBFCs, the Companies Act rotation policy will not apply. The RBI regulations relating to the auditors of NBFCs will apply, where it is very clearly mentioned that the auditors of an NBFCs can hold office as auditor for a maximum period of 3 years, which is get covered by the regulation. That means asset size is more than 1,000 crore or more. Less than 1,000 crore, there is no such mandatory rotation. More than 100 crore, 1,000 crore or more, there is a requirement that auditors should be rotated in every 3 years' time. Another interesting fact is that in respect of a company audit, the auditors, if they have rotated out, they can come back as the auditor after the expiry of 5-year period. That means cool-off period is only 5 consecutive years in respect of audit of a normal company. But if the entity is a NBFC, then the cool-off period is 6 years. So that means after 3 years of continuous audit, I have to wait for at least another 6 years. Only I can come back on the 7th year again as the auditor of the same NBFC. The question which will come to us as a practical question is, if I'm the auditor of an NBFC and I am completing my 3 years period, whether this rotation policy will apply for all my appointment in any NBFC or only for that particular NBFC. Here, the interesting fact is that, as you know, that an audit appointment for an entity can be regulated by means of a rotation and not for the entire sector. Here also, RBI has considered that only for that particular NBFC, the auditors will be rotated out. They can get appointed in another NBFC having asset size of 1,000 crore or more on the 4th year onwards. It is not a problem. Same company, same NBFC, you have to necessarily wait for 6 years of cool-off period, and you can come on the 7th year to come back as the statutory central auditors. Another practical question which may come, and of course now it is redundant, is that what happens if on the day the regulations are applicable, that is financial year 21-22 onwards, if the particular auditor has not satisfying the eligibility requirement, but they are continuing as an auditor, what will be the position? Fortunately, that position is already over because we are in 2024. So the 3 years period, financial year 21-22, the 3-year period is already over. 24-25 is the year in which we are running. But still, suppose an existing auditor who has been appointed in 21-22, and the requirement, what it says is that if they are not fulfilling the requirement of this regulations, they have to either resign or before carrying out the statutory audit of the year end, they should fulfill the requirement. And of course, it's a transitional provision, not having any impact from the current year onwards. If I am speaking in the previous year, definitely I will talk about this, but otherwise it is not required. And the interesting factor is how many auditors should be appointed for carrying out the statutory central audit of an NBFC. Interestingly, again, the asset size of the entity is the criteria for determining the number of minimum statutory central auditors required. Please understand that I'm using the word minimum number of statutory central auditors required. That means the entity may appoint more than the requirement given in RBI regulation if they thought it fit. The criteria which we have to understand is that suppose if the entity has an asset size of 15,000 crores or above, then it should be jointly audited by minimum 2 statutory central auditors. So that means 2 firms has to be appointed as a joint statutory central auditors if the asset size of the entity is more than or equivalent to 15,000 crore. I never saw a financial statement which exactly has 15,000 crore. That's the reason why we normally have a feeling that more than 15,000 crore is a loosely used word, but the actual law says 15,000 crore or above. 2 firms of statutory central auditors should be appointed on a minimum basis. If the management believes that because of the complexity involved or the widespread or geographical spread of the various branches, they wanted to have more than 2 statutory central audit firms, they can appoint another or more than 1 also, in addition to the 2. So it is left to the discretion of the management to decide how many auditors are to be appointed. Okay. So the question is, if my asset size is less than 15,000 crore, how many statutory central auditors to be appointed? The answer is very simple, minimum one, and it can be more than that also, if the company decides to appoint the auditors in accordance to their personal requirement, or maybe according to the management decision, they can appoint more than one audit firm also. Okay, that is left to them. The maximum number is also prescribed. That means they cannot go on appointing, say, for example, I will appoint 7 statutory central auditors or 12 statutory central auditors. They cannot go beyond that level. What they say is that in case, if the asset size is, say, 5 lakh crore or above, but less than 12 lakh crore, then they say the number of auditors can be 4. Suppose if it is more than 20 lakh crore, the number of auditors can be appointed, cannot go beyond 12. So, of course, in practical sense, what I have seen with respect to an NBFC is that they stick on to the minimum requirement and not more than that, because of the cost involved in respect of the various requirements of appointment, monitoring their work, getting the things done, etc. Normally, they stick on to the minimum number and not go beyond that. Very rare occasions, I have seen 1 or 2 cases. Instead of 2, 3 or 4 might have been appointed, not more than that. That's what I have seen, right, in practical sense, right? This is the minimum number of statutory central auditors required. That doesn't mean that there is a restriction on the number of branch auditors also. Absolutely no. It is left to the management to decide in discussion with the statutory central auditors how many number of branch auditors has to be appointed, depending upon the coverage, depending upon the geographical location, depending upon the business size of each of the branches, it can be discussed, and based on which the number of branch auditors may be appointed. I remember that in a banking company audit, top 20 branches with asset size having at least 20% of the overall asset should be covered by the statutory central auditors. The similar restrictions is also be there for the statutory central auditors to cover. So they also cover the branch audits, apart from the branch auditors doing their audit and sending the audit returns to the head office for consolidation purpose. The next question, which comes from the point of view of the audit firm. On one side, we were talking about the number of auditors to be appointed by an NBFC. If I'm an audit firm, how many non-banking financial services company I can do the audit is also another question mark which comes in. Like in the Companies Act, where there are restrictions in the number of companies I can audit, here also the number of NBFCs which I can do audit is also comes with clearly under the RBI regulations. Interestingly, this regulations gives a guidance where it says an audit firm at the same time can be an auditor of 4 commercial banks. 4 commercial banks, but out of that 4, only one can be a public sector bank or all India financial institution like NABARD, SIDBI, etc. So that means PSB, public sector bank, can only one, and 3 private commercial banks, an audit firm can get appointed and carry on the audit simultaneously. It is permitted. And then they are permitted to do an audit of 8 urban cooperative banks. UCBs, 8 statutory central audit you can do. And similarly, 8 NBFCs can also be audited by a firm of chartered accountant. That means in the same year, I can be appointed as the auditor, statutory central auditor of 8 different non-banking financial services company, and I can carry out the audit of the same. One fundamental question which will come to us is, under the Companies Act, when we were looking at the number of companies which will get audited, the maximum number of companies for which auditors will be appointed, we are excluding certain companies which are having a paid up capital of less than, say, for example, 25 lakhs, etc. Whether that type of any exemption is given or any asset size based exemption. Say, for example, when we were talking about 1,000 crore company, less than 1,000 crore asset size company, whether there is any restriction or exemption which is available. Interestingly, it says that no asset size exemption is available. That means the moment I do an audit of an NBFC, maximum number of NBFCs which I can do, including less than 1,000 crore asset size company, is only 8 NBFCs. That's the reason why whenever audit appointments is coming in, the auditors are making an evaluation of which entity or which NBFC can be accepted, so that it will help them to get a maximum remuneration and maximum usability of the entire team. That's the reason why they make this particular assessment as well. One question also comes is that whether the auditors are appointed by Reserve Bank of India for NBFC, like statutory central audit of banks. The answer is no. Actually, NBFCs are permitted to make their own choice of statutory central auditors, but in the order of preference, 2 names should go to the Reserve Bank of India, out of which one, if it is only one company is required, it will be allowed by the Reserve Bank of India. In other words, we will say that if they have already concluded that either one of the firm will be the auditors, this goes as a ratification or confirmation by the Reserve Bank of India. Ratification is also not the correct word, because the appointment is happening at the company level, and it is actually goes as an information to the Reserve Bank of India. That's an interesting factor compared to Reserve Bank of India is appointing the statutory central auditors of banking companies. Now, banking companies, when I'm saying that, public sector banks. The next interesting question which comes is that, is there any restriction on I'm doing a non-audit service for an NBFC if they are proposing to appoint me as the auditor? The very interesting restriction, which we have to be very, very careful in making the assessment. And of course, a practical side of the story is that if you are planning to apply for audit of a non-banking financial services company, you should always be careful that you are not doing any non-audit service work for that particular NBFC, not only in the current year, 1 year before that. There should be a gap of 1 year between the date of you completing the non-banking, non-audit services and the date on which you are getting appointed as a statutory central auditors for that particular company. This rule is applicable for financial year 2022-2023 onwards. So that means you have to be carefully monitor what is your preference, non-audit work or your audit, statutory central audit. If you are planning for a statutory central audit, you have to monitor yourself to ensure this particular requirement of independence has to be maintained. This is basically non-audit services. When you are engaged, it is expected that it may have an impact on your independence, or maybe it may influence the decision which you are making when you are issuing an independent audit report. That's the reason why they are saying 1 clear year of time gap should be available between the period where you have extended the non-audit services and the period where you are going to do the audit of the NBFC. And this restriction is also extended to the group entities also. Before, even though I'm using the word group entities, I must stop a moment and explain RBI regulations relating to audit appointment classified entities into two categories, group entities into two categories. One is RBI regulated group entities, non-regulated group entities. So regulated group entities means whatever business which they are carrying on, maybe an NBFC or deposit taking NBFC or non-deposit taking NBFCs or any other RBI regulation is applicable to the business of a group entity, then that entity is considered as a regulated group entity of the NBFC. So if RBI rules are not at all applicable to any of the entities in the group, they are called non-regulated group entities. So accordingly, if the auditor is providing non-audit services to a regulated group entity, RBI regulated group entity, then the 1 year gap which we are talking about between the completion of the non-audit work and the year in which you are doing the statutory central auditor is remaining to be 1 year. So that 1 year gap is still applicable in respect of group entities which are RBI regulated. For example, if I'm talking about ABC Limited as the entity in which I am going to get appointed, but I have done a non-audit services within the last 1 year to one of their subsidiary companies, and that subsidiary is also covered under RBI regulations, then I am not eligible to get appointed as a statutory central auditor of the NBFCs. So in other words, it gets extended to the entity and to the RBI regulated group entities also, both put together, right? Okay, the next question comes is whether this restriction is applicable only the RBI regulated group entities or it extends to non-regulated group entities as well. Interesting point is the ultimate idea is to maintain independency of the auditors, right? So when we say non-regulated group entities, what it says, the regulation says is that there is no bar that you might have given a non-audit work or a non-regulated group entity. So you can do that. However, the responsibility has been shifted to the audit committee and to the board of directors to evaluate by doing the non-audit services for the non-regulated group entities of the NBFC, whether the auditor's independence will have any impact. So let me just take a small example. The NBFC is going to give me a fee of, say, for example, 50 lakhs to 1 crore, let us assume. Whereas one of the non-regulated group entities is giving me an audit fees of, say, 10 crore. The audit committee of the NBFC and the board has to necessarily evaluate. He is getting a non-audit service fee of 10 crore in another entity, whether he will maintain the independence or his views will be biased when he is doing the statutory central auditor of an NBFC in the group, which is only giving a fee of 50 lakhs or so to maintain the other non-audit work, whether my independence will be compromised as a question mark, and accordingly the responsibility has been shifted to the audit committee and the board. What is the role of the auditor in such situations? The auditor should make it very clear, or expressly he has to talk about the non-audit work which he is doing for the non-regulated group entities and express or maybe put it in a very clear letter and spirit to be known to the audit committee for their evaluation. If the audit committee and board has evaluated and they still believe that it doesn't have any impact on the independence of the auditor, then they can take the call. So that means an informed decision has been taken in respect of non-audit work vis-a-vis the statutory central audit work, especially to ensure that the independence of the statutory central auditors remaining intact. That's the simple reason why it is being done. And there could be another scenarios where there could be a conflict of interest, maybe perceived or maybe existing. We are not sure. It's only perception or it is actually existing. Let me take an example. Say, for example, I'm going to get appointed as the statutory central auditor of ABC Financial Services Limited. In the ABC Financial Services Company, XYZ Limited has taken a huge loan, maybe large exposure of this NBFC is with respect to the amount of loan given to XYZ Limited. I am the auditor of XYZ Limited. So in that case, since my client has a very huge exposure, another client is having very huge exposure, will have an impact on my audit appointment as the statutory central auditor of the NBFC. I am not borrowed, but one of the entity to whom I am doing an audit has borrowed from the NBFC, but that is a significant exposure or large exposure. In that case, before being appointed as a statutory central auditor, the auditor is supposed to make that assessment and inform the audit committee and board. And as we have seen in the case of non-audit work, the similar scenario is applicable to the, or similar responsibility is applicable to the audit committee and the board to evaluate by having such a huge exposure to one particular entity, whether the auditor of that entity can continue to be the auditor of this NBFC. That evaluation should also be done. In 90% of the cases, this will be a perception, but it will be proved incorrect also in many cases. But still, RBI audit regulations very clearly mentioning that this evaluation should be done by the audit committee and board, and the auditor has to expressly explain this. You may ask how the auditor will be able to know whether it is a significant exposure or large exposure in respect of the NBFC. See, the moment I am doing an audit of a particular company, I know what is the borrowing made by that particular company. And that borrowing, if in my view is significant to this particular entity, I should also look at the financial statement of the NBFC, which is going to appoint me as a statutory central auditor. And I will know whether it is a large exposure or not. You may also ask the question, how I will know about the balance sheet if it is not a listed NBFC? It's not a listed NBFC, it's only a public limited. It is not a listed entity. The informations are not publicly available. Please understand that the SQC, Standards and Quality Control, talks very clearly about the audit acceptance and continuance process to be in accordance with SQC 1. Firm level quality control, how you are maintaining. So before I accept an audit, I'm supposed to evaluate the risk involved and the bias which may have or threat to independence which may come when I'm taking the audit of the particular entity. For that purpose, definitely we might have collected the financial statement of the NBFC, even if it is unlisted, and we might have known the exposure which our client will be having with that particular NBFC. That is the reason why it's very clearly information is available for the auditor to make that judgment as well. And of course, if the audit committee and board decides that there is no threat for independence of the auditor, it will record it and then allow the appointment to be taken in place. It's very common nowadays that the Ministry of Corporate Affairs is encouraging or making it mandatory for appointment of independent directors in the corporate entities. Even some of the entities where they don't need that type of independent directors to be appointed, for better corporate governance, they also follow that method. Similar situation can also come if a partner of an audit firm, is also a director in an NBFC. So in that case, is it possible that the firm can get appointed as the auditor of that particular NBFC? Let's take an example. Assuming that I'm an independent director in ABC NBFC, and my firm, Ganesan & Co., is being approached for appointment as a statutory central auditor by ABC. Definitely, I cannot accept the particular audit. So the regulations very clearly mentions that if a partner of the firm is a director of the entity, then the firm itself is ineligible to get appointed as the statutory central auditor of that particular entity. Suppose if we are talking about this, and we talked about non-audit work relating to the entity, group entities which are regulated and not regulated under RBI regulations, whether the similar scenario of I'm an independent director, not in the board of the NBFC, but in another entity in the group, I'm an independent director, or I'm a director of that particular entity. I'm using the word independent director because a chartered accountant cannot be a full-time director and be part of an NBFC, because in that particular scenario, that firm itself will be ineligible to get appointed. So I'm just saying that in that case, independent director of a particular NBFC is not there. I'm not an independent director of the NBFC, but I'm an independent director on the board of a group company, which is also comes under the RBI regulations. In that case, the firm of the chartered accountant will also be ineligible to get appointed as the auditor. So that's the reason why nowadays every firm is managing not necessarily only the client data, but also non-audit services which is being done by the audit firm, as well as the directorship in various companies are considered by the risk management partner of the firm, or at least one of the partners should take the specific requirement to ensure that these regulations are being complied with. So that is very important for any firm which is having more than 2 to 3 partners and doing a lot of bigger audits. They should have this type of compliance. That is what SQC 1 also prescribes to be followed. So the similar restriction of non-audit work of a group company which is regulated will also apply here. So I cannot be a director in a group company which is regulated by RBI, and in that case, the firm in which I am a partner will not be eligible to get appointed as a statutory central auditor. Similarly, if I am a director in one of the group companies which is not a regulated entity under the RBI guidelines, then I should then the firm is eligible to get appointed as a statutory central auditors, but the firm should make very clearly the disclosure that so-and-so partner is a director in another group entity. That should be made to the audit committee and the board. And the audit committee and the board is duty bound to evaluate whether it will have an impact on the independence of the auditor, and based on which the auditor will get appointed. So in simple terms, this particular discussion on audit appointment and RBI regulations is trying to bring in more and more independent, non-biased audit of an NBFC, because the NBFC also deals with the public money. And any failure which is happening in NBFC will have a huge impact on the market and on the individuals, investors, etc. That's the reason why we are having so much of restriction brought in by the Reserve Bank of India. Now, having understood the business, understood the laws and regulations, and now understood the audit appointment requirement, we will move on to how the audit should be looked at. The very simple process, whatever is your audit process for the firm, you can extend that audit process for the entity of an NBFC as well. That's the reason why I used to say, when you are doing an audit of an NBFC, like any other case, you should also understand what are the key business drivers and what is the risk associated with each of the risk, and have you assessed the risk associated with the audit of this particular NBFC, and what is your response to the assessed risk so that the risk of material misstatement can be brought down to the accepted level. Again, the standards on auditing 315 and 330. 315 is talking about how auditors should assess the risk of material misstatement in an audit of an entity, and 330 is talking about what is the audit procedure or responding to the assessed risk by the independent auditor of an entity. Those are applicable even in respect of an NBFC audit. Any audit it is applicable. NBFC being most regulated, it should be very, very clearly documented, and the response should assessed risk should also come in. Why I'm saying very, very clearly to be documented and the response to assessed risk should also be very clearly documented is very simple reason. The regulators of the audit profession, whether ICA or the FRR, ICA, within ICA, FRRB or QRRB or NAFRA, are always looking at whether the auditors have really assessed the risk of material misstatement. Because after all, our audit report is saying that whether the financial statements are free from any material misstatement on the whole, either due to fraud or error. So small misstatements we are not bothered, but material misstatement is very, very important area to be covered. And accordingly, how the auditor has assessed that certain risk in the business of the entity will lead to a possible material misstatement. If so, how the auditor has performed his audit procedure to respond to the assessed risk is very, very critical. Many of the NFRA report, if you have looked at, you might have seen that NFRA has come out very heavily on the audit firms, saying that you have not assessed the risk of material misstatement and your audit procedure have not properly addressed the response to the assessed risk. And accordingly, you have not concluded your audit, carried out your audit properly, and your conclusions will not be eligible to give you a comfort to have a basis for expressing an opinion. So just seeing, after I'm doing an audit of 2 months or 3 months, or maybe throughout the year on a paced manner when I'm doing, and finally somebody comes and says that you don't have a basis for expressing an opinion, that is more embarrassing situation. Accordingly, compliance with the standards on auditing, compliance with assessing the risk of material misstatement is a critical area of starting an audit of this NBFCs. And many NBFCs are large in number. And accordingly, you cannot go with the substantive testing or substantive test of transactions or substantive test of balances by which you can take the complete comfort. You should always look at what is the control environment in which the entity operates, whether the internal control system is commensurate with the size of the business of the entity, and to that extent, whether the controls when tested is not throwing up any big challenges, and show that the controls or the control environment is reliable or not. If the control environment is reliable, the auditors will normally get the comfort by carrying out a test of controls, and based on the test of controls, he decides the extent of the substantive audit procedures to be performed. Okay. So test of controls, how extensively it has to be done, and what should be the impact on the other audit procedure, or maybe the testing strategy which the auditor plans to perform. Another interesting factor, or maybe I can say that the practical way of doing an audit of an NBFC is that for each of the key focus area, the auditor should have a tailored audit procedures. You cannot simply use the audit procedure performed for a manufacturing company or a trading company to an NBFC, because the business of NBFC itself will be completely different. And to that extent, a tailored audit procedure should be carried out for each of the key focus areas. We will discuss certain key focus areas as part of our discussion. And it's not only the key focus area, wherever estimates are involved or management judgments are involved, you have to validate that estimate, management estimates also for two aspects. One, is there any bias for the management to make that estimate? They have some biased view based on which the estimate is manipulated or misreported or miscomputed or miscalculated. Okay, that is one thing. Whether there is a management bias could be possible or not should be audited by the auditor. And second is, you have to do the reperformance of the estimate, the assumptions used in concluding on the estimate, etc., should also be validated by the auditor. Because an estimate could be an area where it may result in a material misstatement in the financial statement. That's the reason why, even in a normal financial statement, we talk about use of estimate and what is the implications of the estimate in the audit of an entity. Here, that is very, very important. The normal estimates where we will be looking at this audit is normally with respect to provision for your bad and doubtful debts, or provision for employee related benefits, etc., or even impairment of asset. Of course, impairment of assets will be very, very minimal in respect of NBFCs, because most of them will be corporate assets rather than manufacturing asset or cash generating on it. But in the case of a financial asset, the evaluation of recoverability, and because of the evaluation which has been made, whether any provision is required to be made with respect to the doubtful cases. I'm particularly avoiding the word expected credit loss, because expected credit loss will apply only to Ind AS companies, and other than Ind AS companies, it will not apply. Even in respect of a banking company, NBFC, which is having less than 250 crores of net worth, and it is not a listed company or proposed listed company, AS will apply and not Ind AS will apply. And that is the reason why I'm specifically avoiding that word. But expected credit loss will be one of the important aspects. But at the same time, we can also take one particular comfort, or I can say we can more focused on the NBFCs using Ind AS, because nowadays the size of the NBFCs are normally more than 250 crore. So naturally, many of the NBFCs will fall. Maybe I can say the 90% of the NBFCs will fall into the Ind AS requirement, and accordingly expected credit loss will also be used. And that expected credit loss is a pure estimate. The model or the method or the way in which they have created should be tested, because it's also an estimate. My auditor should test the various assumptions which have been taken, tallying the numbers with the basic records of the entity, etc., should also be applied. We will come to that ECL model when we are talking about key focus area. I will explain a little further on that. And sometimes you are supposed to make the involvement of subject experts also in an audit of NBFC. You have to actually decide based on the requirement. I always believe that an auditor who is doing an audit of an NBFC without the help of a system process assurance team or IT assurance team is like making a suicidal attempt, because majority of the activities of an NBFC is governed by the IT infrastructure. It is IT driven. So if the information technology is being used for passing an entry, making an adjustment, even approving a particular transaction, etc., if you are doing audit around the computer or audit in a computerized environment, in a smaller company, the auditor himself can be a little bit of expert in doing that validation. But in a company, in an NBFC, which is having, say, for example, 5,000 crores asset size or something like that, you cannot simply do that activity as well. You should require an expert to be involved. And the expert normally will be IT auditors or information systems auditors to be involved even before the statutory audit is getting started. So based on the observations of the information systems auditors, the risk of material misstatement will be identified for each of the areas, and then you should have your audit procedure to respond to the assessed risk. Okay, that's the way in which you have to think about involving experts in the audit. Sometimes taxation experts will also be required because of the complexity of the tax computation relating to an NBFC. You may require the assistance of a partner within the organization who knows very strongly the taxation, or you must also have an external expert who is good at taxation for ensuring that whatever entries arising out of the taxation is being properly computed and passed in the financial statements. So you should have tailored audit procedure for key focus areas. You should audit the management estimate. You should evaluate whether use of experts is required, etc. Normally, for a bigger companies, if it is listed, I'm taking an example of listed NBFCs. Every quarter audit will happen as a limited review. So to that extent, it's not an audit but limited review, but still the auditor will make all the assessments by means of inquiry, and then with the inquiry, the replies which he has taken from the management and other client personnel, he will corroborate that information with audit evidences. So less than a reasonable assurance, the auditor is actually giving a moderate assurance in a limited review. So to that extent, key issues arising during the course of that particular quarterly review will also be taken care by the auditor. And whenever the auditor has identified certain key accounting issue, he should normally discuss that interim findings with the management, and he has to update his audit strategy and audit plan for the subsequent periods and for the year-end audit. That's very, very important, because the audit strategy and audit plan is dynamic in nature. It is not static. So it cannot be simply a tailor-made, it cannot be simply a checklist-based audit. We have to go on updating based on the requirement or new development which is happening, or new audit findings which has been done during the course of the audit. So that the interim findings when gives a guidance for updating the audit strategy and the audit plan, based on which finally the auditor concludes on the audit opinion, how it should be, whether it's qualified or it should be unmodified, etc. He decides based on the outcome of the audit evidences he has collected. But one interesting point is that it is always preferable to issue a management letter on areas of improvement, whatever key audit findings the auditor has observed and how it is acted upon should also be discussed with those charged with governance. The discussion or communication with those charged with governance is also a requirement under the standards on auditing. So this audit process or audit strategy, when it is applied, will allow the auditor to look at the possibility of something goes into as a material misstatement and how it can be identified and maybe prevented, or if it has already occurred, how it can be identified and remedial entries or remedial action can be taken to ensure that the financial statements are fairly presented. Another area I normally talk about with respect to audit of a non-banking financial services company is nothing but use of data analytic tools. During the bank audit season, the WASB normally conducts a lot of sessions on use of audit tools or automation tools to carry out the audit of a even bank branch audit. Similar scenarios will also be applicable for a non-banking financial services company because the entire data is coming out of an IT-driven environment. And instead of you just doing a substantive audit procedure or control testing, it could be better if you could use data analytic tools and audit the 100% of the data or create what if conditions, which as an auditor you will ask out of the data analytics. And those exceptions can be deep dived into. That is what I believe is an important outcome arising out of the data analytic tools. In fact, I have seen that the identified exceptions and control weaknesses using data analytics could be much, much wider and more in-depth compared to an audit which is conducted on a manual audit process. That is very interesting for you to look at use of data analytics and think over. Having planned for the audit, having determined what are all the technology which I am supposed to use, and now I believe that the audit areas or focus areas for carrying out the audit, I'm dividing it to some 6, 7, 8 categories. So one by one we will discuss. The first one is the loans and other financial assets. That is the actual assets which is actually given to the third party or the borrowers. And if it is not properly collected, the principal itself becoming a issue to be provided for. If I am assuming that everything is fully collectible, without even validating that, my audit procedure will not be correct. And accordingly, there's a lot of information which you have to look at. So they call it as what is a portfolio at risk? If, for example, if I'm saying one EMI is outstanding for one day, they will say par 1. That means one day is outstanding. If the par is more than 30 days, that is overdue for more than 30 days, then the risk is actually heightened. If it is more than 30 days, the auditor should also look at whether it is really recoverable or the entire principal is to be closely monitored. Okay, like you have to monitor the accounts. SMA accounts is also one of the technological term which we normally use for NBFC. You have to look at whether there is any provision required for expected credit loss. Now I am using the word expected credit loss for one reason. Maybe 50 to 60 or maybe 70 to 75% of the NBFCs which we are auditing could be listed companies or having a net worth of more than 250 crore and accordingly following Ind AS. The moment they are following Ind AS, the provision should be made in accordance with Ind AS 109 for impairment of financial assets, where you will create an allowance for expected credit loss model, credit loss. The audit committee specifically has been given a responsibility, and the board is also having a responsibility so this will also give a responsibility for the auditor to look at. Sir, I could not see the comment. What is the time up to which you are saying? At what time Sir Rahulji will start the session?
Yeah, I think, sir, I would request you to please wind up your session. It's going to be
Okay.
4:15 now, no?
Quickly
Yeah, so
summarize.
we'll join in 2 minutes. Yeah, yeah.
5 to 10 minutes max. So, the expected credit loss, which is an important area of consideration. The second important area is majority of the NBFCs are looking at direct acquisitions of portfolios. The DA portfolio is nothing but where they have a portfolio, either they sell the portfolio to other companies, NBFCs, or they buy from other NBFCs based on the requirement of RBI to comply with the RBI regulations as well. But the accounting should be in accordance with Ind AS 105, which is what we are supposed to look at. When they are working on this, the loans given to the related parties, as we have already discussed, should also be a primary importance. And of course, based on the profit made by the entity, you are also supposed to look at it. You are also supposed to look at whether a proper provision for statutory reserve has also been created in accordance with the RBI guidelines. The next area of importance is investments made in group companies, investment made in non-convertible debentures, debt funds, and what is the related fair value accounting arising out of that particular portfolio also is one of the areas. Similarly, there could be a borrowing or debt securities issued by the NBFCs. Their accounting is also important because if it is a non-convertible redeemable debentures or redeemable preference shares, amortized cost accounting comes into the picture. If it is compulsorily convertible debentures or preference shares, then the accounting under Ind AS 32 split that between equity and financial liability also comes into the picture. The term loans taken from banks and other institutions or maybe short-term loans which they have taken should also be a consideration. The application of effective rate of interest is another area of looking at. This covers basically the areas relating to the balance sheet, major areas. When it comes to the statement of profit and loss, the areas which I believe is a very big areas to be covered is the revenue from operations. In an NBFC, they may collect upfront processing fee and may incur acquisition costs like brokerage, commission, etc. According to the AR model, they should also be spread over the period for which the particular loan will be repaid by the borrower. So that AR model should be looked into for interest accounting, processing fee, and also for acquisition cost deferment. Everything should be looked into. Majority of the NBFCs are normally issuing employee stock option plan. According to Ind AS 102 should also be looked into as an important aspect. As I have already mentioned, the estimates relating to gratuity, compensated absence, or any other employee benefits should also be looked into. Because the major cost for an NBFC, other than the interest cost, will be relating to employee cost. That's the reason why we are supposed to look at finance cost. When you have validated the debt securities and other borrowings, the outcome of that is also a validation of the various finance costs which you have incurred on loans, debentures, and other items. And one area where there could be a possible additional requirement you have to consider is accounting for leases under Ind AS 116, because majority of the NBFCs will be having many branches. All of them may be in leased premises with a lock-in period, and to that extent, the amortized cost accounting for the rental deposit given, depreciation for the leasehold improvements which they have made, and accounting for the right of use asset, accounting for the lease liability, accounting the interest on the lease liability, depreciating the right of use asset, all those areas are special focus areas automatically. Property, plant, equipment, even though it is one of the areas to be considered as key focus area, but I believe that it is not a very serious matter, because normally if you follow Schedule 2 model of the Companies Act, you will be taken care by the property, plant, equipment on the useful life estimation, residual value estimation, depreciation charge, etc. Impairment testing will be very, very rare in respect of this entity. But of course, the next important point, other than the financial statements, is your compliance on various Reserve Bank prudential norms and other circulars, compliance with the Companies Act, compliance with the direct and indirect taxes, compliance even with the income computation and disclosure standards has to be looked into. And I think that these are the major areas. And last but not the least is looking at the presentation and disclosure of the financial statement in accordance with the financial reporting framework. So if it is an NDS company, you know that Schedule 3, Division 2 is prescribing what is the format which you are supposed to use for a non-banking financial services company. And the other items is in a non-banking financial services company, contingent liabilities or litigations will be much, much higher. And to that extent, the assessment of and presentation and disclosure of contingent liability, evaluating whether any specific liability, contingent liability has to be upgraded to an ascertained liability is also an area of focus which we are supposed to look at. I think that is what I wanted to cover as part of my presentation. And now I will give it to the moderators to take it further on this.
Yeah, thank you, sir. That was very insightful. And I request Rahul, sir, if you could take the session from here. Thank you.
Tushar, is that visible?
Yes, sir. We can see the PPT.
So, thanks, Dr. Ganeshan, for such an intellectual and insightful presentation. And also thanks AASB for giving me an opportunity to present my understanding on the key consideration while doing audit of NBFC. Thanks Tushar and Asta for a nice introduction of mine. So guys, that will try to give a simplified approach for our today topic in the next an hour, or maybe cut short to 45 minutes. And a very good afternoon to all. So moving to the agenda is that we will focus on the background, regulatory framework, scale-based regulation, financial reporting framework, and audit framework. So Dr. Ganeshan has taken in detail and will go in detail of my last and important agenda, and rest of will touch base. I would appreciate if you could leave any question you may have until the end of my presentation. Let's start with the background. Non-banking financial company is a non-banking financial institution, which is a company registered under the Companies Act, which is engaged in the business of giving loan advances, acquisition of share, stock, bonds, debentures, securities, or any of the marketable nature, leasing and hire purchase, insurance business, and cheat fund business. It does not include of the agriculture activity, industrial activities, sale, purchase, construction of immovable properties. This is the definition as per the RBI is given. The regulatory framework, as we all aware by the name of is been regulated by the Reserve Bank of India. And by definition of NBFC, section 45(1)(f) is talk about a financial institution, which is a company, which is a non-banking institution, which has its principal business of receiving deposit under any scheme of arrangement or any other manner or lending in any manner. Such other non-banking institution or class of such institution as the bank may, with the previous approval of the central government and by notification in the official specified. The principal business criteria for NBFC other than HFC, Housing Finance Company, the company will be treated as an NBFC if its financial assets are more than 50% of its total assets, netting off by intangible assets. And income from financial assets should be more than 50% of the gross income. For Housing Finance Company, whose financial assets in the business of the providing finance for housing constitute at least 60% of its total assets, netting off by intangible assets, and very specifically out of the total assets, not less than 50% should be by way of housing financing for individuals. It is very important. 45(1)(c) talks about defined financial institution, and it is very important section 45(1)(a), which talk about certification, registration, and net own fund. Earlier was that any net own fund of the 25 lakh or such other amount not exceeding 100 crore rupees as the bank may by notification the official gazette. Here the bank means Reserve Bank of India. Bank may notify different amount of net own fund for different category of non-banking financial company. In the next slide, we'll talk about this. Now this net own fund is increased to rupees 2 crore. Wide scale-based regulation come into picture in October 22, and it's going to be increased by to 10 crore by 2027 in the phased manner. There is a lot of direction each of the NBFC company and the circulars that RBI is time to time issuing. Now you've seen that the Reserve Bank of India is very active. I must say that is on the real-time basis. They come out with the circular of any of the impact in the industry. As we are increased threshold and all that we talk about, classification and structure. Now the one question is that, is any NBFC can do business without getting certificate of registration? The answer is no. Is any NBFC do business having below net own fund which is prescribed? Answer is yes, but up to 3 months. For very specific reason, they can do the business up to the 6 months. This is the type of the NBFC, that investment and credit company, infrastructure finance company, core investment company, infrastructure debt fund, non-banking finance company, microfinance institution, NBFC factor, mortgage guarantee companies, non-operative financial holding company, non-banking financial company, peer-to-peer lending, and housing finance company registered under NHB Act. So we talk about net own fund like IFC, infrastructure finance company, is minimum 300 crore. Infrastructure debt fund is minimum net own fund is 300 crore. Mortgage guarantee is 100 crore, so on. So there is some assumption that from the 45, 1A, 1B, and 1C to certain type of NBFC, there is as per the direction and condition issued by the RBI, like merchant banking companies, stock exchange, stock broker, venture capital fund, alternative investment fund. This is governed by the SEBI. So that's why this assumption is given. Security registration company, insurance company is governed by RADA. Chit fund is governed by Chit Fund Act. Nidhi company is governed by MC and Government of India. So we talk about scale-based regulation. This is that scale-based regulation is covered all the NBFC in the 4 layer. Base layer, there is non-deposit taking NBFC with asset size less than 100,000 crore. Middle layer, the deposit taking or not deposit taking NBFC with asset size more than 1,000 crore. And upper layer, that upper layer is decided by the RBI based on certain parameters. Nowadays, it's 15 NBFC specified by RBI as the upper layer. Top layer usually empty, the RBI specified based on this risk. This regulation is come out in the October 1st, 2022. Done away with any, earlier we talk about NBFC non-deposit taking, systematic NBFC deposit taking, like that. So this is categorization is layer-based categorization based on the risk, size, and operation. Revision and regulatory guidance on raising minimum net on fund, harmonizing NPN norms, experience of the board or IPO funding ceiling. This is very important that the RBI has come out with the specific layer having restriction in the revision in the governance guideline of the risk management committee, disclosure in the financial statement, loan to director and officer, restriction on KMP or independent director, and mandatory chief risk and compliance officer. Competition policy, risk-based internal audit, liquidity risk, and management policy. they raised the, after this SBR, they raised the net own fund requirement for NBFC, ICC or MFI or factor to 10 crore instead of 2 crore. NBFC non-deposit taking are now required to classify assets with an overdue period of more than 90 days, or NPA from earlier is 180 days for the base layer entity. At least one director in the board of directors should have relevant experience of having worked in the bank and NBFC. This is now imposed. NBFC with the asset size of more than 5,000 crore in the category NBFC, ICC, IFC, MFI, factors, and IDF shall appoint chief risk officer with clearly specified role and responsibility. NBFC is upper layer to get listed within 3 years of the identification as NBFC upper layer. If it is unlisted, then draw a board approval map to compliance and disclosure requirement of the listed company. There is a lot of disclosure requirement of large exposure framework, and in which that a single counterparty must not be higher than 20% of NBFC available eligible capital base at all time. Revision the capital guideline, introduction of internal capital adequacy assessment process, introduction of the common equity tier 1. Revision the prudential guideline on the concentration of the credit investment and sensitive sector exposure and regulatory restriction on loan. This is all the guideline and restriction is imposed now after come out with these scale-based regulation. These are the 15 non-banking financial company which is being categorized as the upper layer for 23-24. It may be changed year to year and decided by the RBI. LIC, Bajaj, Shriram, Tata Sons, L&T, Piramal, Cholamandalam, India Bulls, Mahindra, Tata Capital, PNB Housing Finance, SDB, Aditya Birla, Muthoot, and Bajaj Housing Finance. In today's newspaper, you are seeing that Bajaj Housing Finance Limited has come out with the IPOs of 6,560 crore. It's specially mentioned that Bajaj Housing Finance has been upper layer identified by the Reserve Bank of India. Financial reporting framework. As we already touched base, that net worth above 250 crore in the last preceding financial year in days as per the Company Act is applicable. Net worth below 250 crore as per, then they have to follow the IGAP. Can someone tell me what is required at NBFC to follow in which schedule? NBFC is required to comply with Division 3 of the Schedule 3 to Companies Act 2023 in respect of presentation disclosure in financial statement apart from disclosure requirement of RBI Master Direction Circular. Can someone tell me that what is Division 1? Who is going to follow the Division 1 and Division 2? Division 1 company which is following the IGAP, not the Ind AS, and Division 2 other than the bank, NBFC insurance company following the Ind AS. And Division 3 is followed by NBFC. This is the main area that we need to cover. Auditor's appointment duty, we are skipping right now because my preceding speaker is taken very extensively and very detailed. So compliance and reporting obligation, apart from the obligation and the requirement of the Companies Act, auditor of the NBFC report to the shareholder as per the Companies Act, also give the additional report to the board of directors pursuant to the RBI master direction as amended. What does it talk about? They have to tell that the board of directors of the all compliant criteria like certification of registration, net own fund, the companies borrowing within the limit as approved by the board, the capital adequacy ratio, and the return as well as the compliance. If there is any exception on these the parameter, then exception report go to the nodal agency by the statutory auditor. This is the auditing framework, audit of NBFC. When NBFC comes to the picture, that we have to think about the loans, borrowing, finance cost, interest income, and the other area. But in all the audit, we must have to do that planning and understanding about the entity and its environment. Is it must? Unless until we don't understand the operation or the process, we will not able to do proper audit. So we have to spend time, even much more in the planning understanding about the entity and its environment than the substantive testing. Risk assessment, including ITGC, Information Technology General Control, or ITEC, Information Technology Automatic Control Testing. We have to identify each of the process or each of the financial line item in which, sorry. Line item in which that what we feel that the company having a risk, whether risk is a material misstatement, significant risk, or anything. Use of the expert, whether it's related to management or external, including the coordination with the joint auditor and component auditor. We'll talk about this joint auditor and component auditor in the next slide. We have to do the substantive and control testing. This all after understanding risk assessment, what could go wrong, and the view of the expert, whether management expert or external expert about the any of the specific area will feel, then we plan our control testing. And after the control reliance, then we plan our substantive testing. We have to keep in mind regulatory compliance, because audit of the NBFC is more regulatory compliance than non-NBFC company. And at last, we have to be during the audit or at the end of the communication with those charged with governance must. Sometime, in the throughout the audit period, we have not come across a discussion with those charged with the governance, only at the end when the audit committee and board meetings comes. Area of significance. This is loan receivable. Investment, when talk about the audit of the NBFC. Bank balances. Borrowing and finance cost. Securitization and assignment. Derivatives. Income. But if you say that loan receivable is the main character of the audit of the NBFC, they are the supporting character, but the main driver or the main character is the loan receivable. And the whole audit, if I'll say that, the main focus on the loan receivables. So this area of significant loan receivable, we taken it is, and we explained about how the planning, testing, risk assessment, substantive testing, everything about the loan receivable, and other areas can be, understand from this coverage of the loan significance or loan receivables. Planning. As we talked, understanding the entity and its operation, we have to understand the whole entity, whether it's a 5,000 crore or 250 crore or 50,000 crore, or their number of locations, number of branches, roles and responsibility, authority matrix, and there is governance structure that we have to see and document what their governance structure, including the relevant RBI regulation. Understanding the accounting and internal control system, we have to understand whether there is accounting is centralized, if they have a number of location, or decentralized. What their internal control system is, that is being external or they have an internal team, including the risk management and internal audit function. Communication with those charged with governance on audit plan. After the audit plan, we have to sit with those charged with the governance if any understanding or clarification or inquiry that we need to take from those charged with governance. Discussion with management, other on fraud, including review of the fraud reporting to RBI. So RBI has also come out with a circular where any amount involved in the fraud, 1 crore above, the report in the prescribed format shall be sent within 3 weeks from the date of detection of the fraud to the Central Fraud Monitoring Cell of the RBI. Where the amount involved is fraud is less than 1 crore, report in the format given the FMR 1 shall be sent to Regional Office of Department of Non-Banking Supervision of the bank. Under the registered office, the applicable NBFC falls. within 3 weeks from the date of detection of the fraud. There is another case, is this case of attempted fraud. All the individual cases involving 25 lakh or more should be continued to be placed before the audit committee of the applicable NBFC board. There is one more circular issued on 15, where the applicable NBFC shall furnish FMR in individual fraud case irrespective of the amount involved immediately, but not later than 14 days from the date of classification of incident account as fraud. This is very important in the NBFC company, because that you have seen that number of NPA, number of willful defaulter and all that you have seen in the newspaper as well. So it's a major area that we have to see that any of the fraud in collection or the onboarding of customer, it should not be happen. Or we have to see our control and our risk surround of this fraud. Identification of related party is very important, that we have to see who are the related party of this NBFC company, who are the related party of the promoter or the key management person. Allocation responsibility of joint auditor. This is very important, is that when we talk about that loan set is more than 50,000 crore, then there is a requirement of 2 joint auditor, 2 auditors on a particular NBFC, and the coordination between the auditors is must. There is SA 299 in which auditor has to allocate each and every area between them according to their expertise, according to their comfortableness or whatever it may be. There is a common area as well in which both the auditors has to work, and it doesn't mean that if they allocate any of the area, the other auditor will not be responsible of the areas being conducted by the other auditor. Both are responsible, and both have to review the plan of each of the auditor in particular area, whether really is significant risk or any of the risk of material misstatement presumed. And whatever the allocation of area, that has to be communicated with the HR, with governance of the particular NBFC company. Is must. Without allocation, without proper understanding and written documentation of the allocation of work, there is any responsibility or the education, how the performance or the quality of the education can be hampered. Communication of component auditor, SA 600. There is a group company or there is a parent or the component auditor relationship, or maybe there is a branch. You must have seen that recent NFRA order on this particular SA 600 cannot be ignored, that what is the relationship between the parent company and component auditor, and what is that the responsibility, as well as the parent auditor has to review, has to plan in a proper way that any of the material misstatement cannot be only dependent on the component auditor what is they are reporting. They cannot blind their eyes if there is anything fraud or any of the material misstatements going on. So component auditor also be competent, that's not an issue, but issue is that how they plan and how they come out with any of the material misstatement area. Determination of materiality and appropriate benchmark. This is also very important, that how to determine the materiality and perform a materiality. Risk assessment, as we talked, that identification of inherent risk, what could go wrong at the assertion level, and the control risk. What could go wrong in each of the process or any of the financial line item that we have to see, and we have to see the control surrounding on this risk, and what the entity design the control, implement the control, and as an auditor, we have to test the control. If they are properly designed and implemented as well, but if we test the operating effectiveness, it's failed, it means there is no control. Risk of overstatement of loan receivable, risk of understatement of loan receivables, risk of recovery from the customer, including depletion of the value of the security offered. Risk of inappropriate ESL. Why we are talking about ESL? Because as Dr. Ganeshan is also said, the majority of the India is compliant NBFC, and in accordance with the income recognition, asset classification, provisioning of the RBI potential norms. loans not de-recognized despite de-recognition criteria met or vice versa. In this securitization or assignment, we have to see that whether loan not de-recognized or is required de-recognized but not de-recognized. Loan written off without any recovery attempt or justification being submitted to those charged with governance. This is the risk assessment that we have to see in the loan receivable area, and we have to plan the controls as well as the substantive testing. Substantive testing, that after we complete our control, then we have to see that what is the control or risk assessment is that, then we have to choose our sample testing of the loan file for ensuring KYC norms have been complied with. You must have heard or must have read that there is number of NBFC or bank has been banned or sanctioned because of the KYC norms in the recent times. Security document bear evidence of registration as appropriate and that the NBFC has received appropriate legal advice about the security legal enforceability. There should be a title search and the security document has to be registered in the CASI. There is a central repository of the security or MCA. We have to show that NBFC has to security document has to be registered in the CASI in the two way. One is that we have the first who registered our loan security. Second, if there is any security before our loan is given, that we have to see. Analyze exposure to borrower. What is the balance sheet talk about? Ascertain the exposure type, large or not, interest rates, majority date, repayment terms, security and stated purpose of the exposure. It may be vary in the maturity, but also that interest rate we have to see there is should not be much gap. If there is much gap between the interest rate between the same borrower, then there should be some logic. Consider whether the fair value of security appears adequate. At the every year end, that we have to plan that security fair value has to be ascertained, that has to be more than the loan outstanding. Whether appropriate authority level within the NBFC has approved the exposure application or renewal. Analysis of loan return of technical settlement from the legal and recovery document, including return of approval. We have to analyze the loan return of, that is a technical, we talk about what is the technical settlement from the legal and recovery document, and including the approval from the NBFC, those charged with governance. Whether covered under related party transaction, verification necessary supporting documents. Analysis of compromise settlement cases, including surfacing matter. Earlier, that before the surfacing, there is only the DRT and the civil, court, where the NBFC or any of the lender can go. But the Surfacing Act given the more power to the NBFC, in which they can, attach the security to recover their NPA loan. Compromise settlement for this purpose shall refer to a negotiated arrangement with the borrower to fully settle the claim of the regulatory entity NBFC against the borrower in cash. It may entail some sacrifice of the amount due from the borrower on the part of regulatory entity with the corresponding waiver of the claim of NBFC against the borrower to that extent. And what about technical written off? For this, the purpose shall refer to cases where the non-performing assets remain outstanding at the borrower loan account level, but are written off by the regulatory entity only for the accounting purpose. So without involving any waiver of claim against the borrower or without prejudice to the recovery of the same. Compromise is loan is already settled. There has to be accounted for the penal account, and technical written off is that we are still claiming, but for the reduce the NPA, we have written off in the books of account. Impairment assessment. NBFC, this is a first is loan receivable, and this is the sub part of the impairment assessment. This is very important. NBFC shall hold impairment allowance as required by the Ind AS 109. We again talk about Ind AS. NBFC shall also maintain the assets classification, compute provision as per the extent prudential norm as per the RBI, including borrower beneficiary wise classification, all that. This impairment allowance has to be made. It's not like one NBFC entity has to be make their estimation and model applicable to the whole loan classification. That has to be see that risk and the nature of the loan. It can be vary if we have given the loan to the developer, we have given the loan to the individual, we have given the loan to the consumer durator, we have given the loan for the two-wheeler or the car loan. Where impairment allowance under Ind AS is lower than the provision required under the RBI prudential norm, NBFC shall appropriate the difference from their net profit, and they have to be disclosed. This is that prudential norm that they categorize standard. In all the loan, they have to make the provision of 0.40%. Substandard if it is more than 90 days to 1 year, 15% if it's secured, unsecured is 25%. More than 1 year, 25%, 1 to 3 year 40, more than 3 year 100, and then 100%. So NPA is a loan or advances where interest or installment of principal remain overdue for a period of more than 90 days. ECL that we already talked about in detail, that there's a ECL is what is a historical experience of the particular NBFC in which they have to see the probability of default, loss given default, and given the weightage, and that how many days that any of the nature of loan in which number of thing is having a loan in a particular bucket of the stage 1, stage 2, and stage 3. There is a regulatory compliance. This is a mandatory report from the statutory auditor, which apart from the audit report as per the Companies Act or the additional report or the exception report to the RBI, there is a requirement in statutory certified annually to effect that NBFC is engaged in the business of NBFC. Certification compliance with FDI norms, certification overseas investment, Schedule 1 annual letter in case of HFC, Schedule 2 half year in case of HFC to ensure compliance with various potential norms. Management submit various return and report as per the master direction to that. The communication of TCWG is very important because I already talked. We have to be talk, we have to be inquired, we have to get the understanding, we have to take the clarification any of the issue or the significant finding of from the audit from the person that charged with the corporate governance. Responsibility should communicate with those charged with governance in audit of financial state on the following matter. The auditor responsibility in relation to financials, plan scope, timing. We have to, at the initial stage of the planning, we have to, discuss with our plan scope and timing of the audit. Significant finding during the audit, not we have to wait, but we have to discuss whenever we find that we need to clarification before going forward. Estimate made involving significant management judgment or assumption and our independence. This is more important. So I try to finish, within a time. If you have any question, please let us know so that we can conclude this presentation.
Thank you, Rahul sir. That was really, really insightful. And I know there was paucity of time, but you tried to cover almost everything. And I'll probably put up a couple of questions with you in the interest of time. I know you have a meeting at 5. So the first question is, so that any observations from the peer reviews or any regulatory observations which are common pitfalls that you've come across in your experience and auditors should be mindful of, while performing their procedures?
The peer reviews, we are lacking on the planning part. So
okay,
what is our planning? That is the more important than the education and substantive testing. How we plan the NBFC, how we understand the environment, how we understand the risk pertain to particular NBFC company. So this is very important that every peer reviewer to understand what is that we start our audit. And we have depute our, engagement team according to their experience, according to the size of the NBFC, and what is the experience of the engagement partner as well. That is very important. And if any of the significant matter or the key matter in the audit, how we conclude, what is the document evidence that behind our conclusion on a particular area as well as the overall financial statement.
Got it, so fair point. And the second question would be that at what frequency should the collateral provided by the customers against loan, it is required to be appraised? At what frequencies? I mean, should be annual or at an interval of 3 years? I know Ganeshan sir is also there. So,
Okay.
yeah, any of the two of you can answer. Sir, I'll just repeat the question. At what frequency is the collateral required to be appraised? Is there a guidance, or this depends upon the judgment of a bank whenever they find it reasonable to do it?
Tushar, as per my understanding, that collector that we have to see, according to the exposure of the particular NBFC, right?
Okay.
And we can see that in the rotational, we can see that last valuation of this particular collateral of our audit. It can be, depend on the risk or exposure. We can do if it is listed company in quarterly as well, half-yearly as
Got
well,
it.
or annually as well.
Got it, sir. Fair point. And any specific fraud risks that you've identified in your audit engagements, for an NBFC? I know revenue and management of risk of management override are the presumed risks, but any specific risk that you identify on your engagements?
See that fraud risk can be at any of the process or any of the
Okay.
third party or external party that we are engaged. Even that in the collection, in the big NBFC company, they hired number of collection agent as well, right?
Okay.
When a particular NPA, they are, taking the external agency. There is so many external agency working, on the business or the extended part of the NBFC. So there is also one fraud that any of the collection agency is doing. If they are, collecting from the customer or maybe not depositing to the company, and the NPA is still NPA and continue to be written off in the future. That may be apart from the loan, apart from the security, apart from the anything. But there is also a area that we have to see. We have as an auditor, we have to see.
So, sir, as a mitigation,
I will just add. I will just add to what Rahul was mentioning. The key fraud risk which we normally look at in respect of an NBFC is on one is the NPA identification, and the second is what we have also seen as the direct acquisition is being used for reporting profits at a very high level at the year ends. That's the reason why when we do an audit of an NBFC which is having an income, we make a quarterly comparison of the performance vis-a-vis the final year end number. Normally, if you see the 9 months number, sometimes will be highly going up in the last quarter because they are having year-on-year performance as one of the pressure. So the pressure of performance is normally a point of consideration for the auditor to determine the fraud risk and the level of impact which a fraud risk can happen in an audit of an NBFC, like any other audit which we are doing. And revenue recognition per se, I don't think that there could be any major issues, but I understand that the direct acquisition helping them to account the profits upfront. And similarly, the processing fees and other items are also accounted on a upfront basis rather than deferring it on a amortized cost basis and effective interest rate model. So, and otherwise, the regulations which is being given by RBI relating to fraud cases, the reporting itself is very stringent. So the risk management committee of the particular NBFC should follow all the norms to identify, report to the audit committee, report to the board, and based on which the reporting to the RBI will also happen. Cybercrime is also one of the areas which happens on the NBFCs because majority of the activities are cloud-based activities. And if something happens in the service providers scenarios, it will also impact on the customers. RBI and bank, they normally considers that even if the cybercrime related activity is happening at the customer's mistake, they can sometimes consider that as a non-compliance with the strengthening of the IT infrastructure by the NBFCs, and to that extent, they are levying penalty on that also. KYC is another area where there could be a lot of fraud. Very recently, we come across a case where voters' ID has been used by the NBFC as the particular what you call identification of the customer's address, etc. There was a loophole which has been identified by a particular geography, and they have given loans to nearly 400, 500 people in one stroke, and all those loans seems to be a bogus loans. The KYC norms has been completely manipulated. And how you can identify this as an auditor is if there is a spurt of increase in disbursement in a particular month or particular geography, or that is the reason why I said data analytics will be an important tool. And these are the areas where you can actually look at whether there is a fraud on the NBFC or fraud by manipulated financial reporting, etc. is what we are look at as the auditors.
Got it, sir. Sir, just a follow-up to this. Do you think we can set materiality on an entity level, or we go branch by branch? Because
normally for the branch auditors, the materiality is fixed at the branch level. But as far as the statutory central audit is concerned, we have to look at the company as a whole as a materiality. And of course, for non-compliance, the materiality may be kept at a very low level or even at a zero level, because if non-compliance is there, the standards on auditing SA 700, 705 says the auditor should modify their opinion for the non-compliances. And of course, you can evaluate what is the impact and what is the penalty which will be leviable on that, whether that has been properly provided for, etc. can also be analyzed. But the materiality should be at the company as a whole, at the financial statement level, and of course at the assertion level also you have to think about setting the materiality, setting up.
I'm adding to Shah is that now we have seen number of penalty imposed by the RBI, that what Dr. Ganesh talked about on the non-compliance. But materiality as a whole, as a financial level is fine, but when we have a branches in other location, then we have to fix the materiality so that proper quality audit can be perceived.
Correct. So, that's a branch auditor's responsibility is to fix up. And there is a debate which very recently started is that whether I can simply rely on the branch auditor's returns. NFRA is looking at SA 600, whether that could be completely relied on the work of the branch auditors, or the component auditor or the joint statutory central auditor has the whole responsibility. And to that extent, I think that hereafter the group audit instruction which is going on to the branch auditors will be much more stringent, including defining what should be the materiality and what should be the reporting framework to the statutory central auditors. That's what my perception based on what is the development which is happening now.
Correct.
Okay. And Asta, do you want to take the other questions in the chat box?
Yeah, I think since we're already running short of time, just a very quick and I think an easy question also. What are the key ratios that the auditor should check while conducting the audit of NBFC? Maybe like top 5 ratios that could, affect the audit.
See, RBI has actually given the list of various ratios to be maintained by NBFCs.
Right.
And those will determine the even the net worth, etc. is also net worth funds, etc. has also been looked into, and accordingly, all the ratios which are critical as per the RBI guidelines should be considered by the auditor for his validation. So that is from the perspective of the RBI or regulatory perspective. From the financial statement perspective, when we do an analytical review of the financial statement to ensure that there is no much fluctuation in the reported assets or liabilities compared to the previous period or benchmarking with the industry, I think that we can apply all the ratios which we normally use in Schedule 3 format, the amendment format.
Right, the 12 ratios that have come up. Correct.
Yeah. So, but the RBI circular is expecting certain ratios to be looked into. That has to be necessarily validated by the auditor to that extent that the management is disclosing it as part of the financial statement.
Rahul, so you were saying something?
Yeah, that is what Dr. Ganesh is adding that, percentage of GA, gross NPA, net NPA, debt equity ratio, capital adequacy ratio, that is what is net profit margin. This is that the prescribed by the this ratio, debt service coverage ratio, interest service coverage ratio, debenture distribution reserve, net worth. These are the ratio that is very important in the NBFC.
Okay. I think we can invite Anil sir to. Okay, there are more questions that have come up from the audience. Just a second. Okay. Please explain the concept of core investment company and the related compliance requirements under RBI regulations. May I
Rahul
repeat the
sir, can you
question?
take up the?
Yeah,
What does that come again?
I'll just repeat it. Please explain the concept of core investment company and the related compliance requirements under RBI regulation. CIC.
CIC.
Core investment company.
Mm-hmm.
The core investment company is normally invest only in the group companies. Normally, they are planning to structure it in such a manner. But the core investment company's compliance is very, very straightforward compared to a normal NBFC. So I don't think that there could be any major audit issues arising out of it. Any additional point, Rahulji, you can actually.
No, nothing.
Okay. Please explain the key points for MFI NBFC audits considering the volume and ticket size.
Considering the volume, right?
Right.
Yeah, that is the reason why when I have presented as well as Mr. Rahulji is presented, we were talking about the use of technology as the important aspect and data analytic tools and other aspects to be involved, including using your system process assurance or whatever name you call information systems auditors, etc. That should be the primary basis for determining the risk of material misstatement in various areas at assertion level, and then go for a deep dive into planning your audit strategy. Otherwise, it is very difficult to ensure that all the compliance. I will give a simple example. The expected credit loss in one of the NBFC has been prepared using just Excel sheet. And when we have analyzed the Excel sheet, it was a summary sheet which is given to us for validation. When we asked for the corroborative or additional document from which the links are coming in, they were trying to give some 100, 150 Excels from which an auditor will not be able to even verify from where it starts. So what we have simply done is we just took the the portfolio at risk or the amount of exposure at risk, and then applied Ind AS 109 based on what the other companies are using for stage 1, stage 2, and stage 3 asset, and worked out what could be the possible expected credit loss for this company, and compared that with what the provision which has been held. When that there is a significant difference, we ask them to make us to have a complete walkthrough of the entire ECL model. So when they were trying to do, they will also not able to identify. There are a lot of interlinked Excel sheets which has been used. Then what we have done is we have asked them to use some dedicated service provider who is using software as a tool for doing it. And we identified that the provision was shorter by around 15 crore. And cumulative impact, of course, it could be. But it is always preferable that how much automation, how much reliance on technology could be the basis for doing all these activities because of the volume involved in respect of an NBFC.
So microfinance you're talking about is a very, small ticket size and low duration, item. And there is huge numbers, that we have to rely on the technology to check the control of the management, how they control it. So that is one. Substantive of even of the sample is next to impossible. So we have to rely on the control first. We have to see that how the KYC and customer onboarding process, that is, we have to see that. This is the key issue on the microfinance. And return of procedure also very stringent. Maybe that more than 180 days that you have to, 100% return off as a technical.
So there's one more question that is in the chat box. So, someone has asked that, is there a basic difference between an NBFC and a fintech company as per the regulations of RBI? I mean, what could be those differences between an NBFC and a fintech company?
If I have understood properly, this question. Fintech companies are not NBFCs. They are giving more service to the financial services company is what they are trying to understand, if I'm not wrong. If that is the case, the regulations of RBI with respect to the what you call asset management, asset quality, etc., will not apply to a fintech company. So the NBFCs is more or like a banking company audit, so where the norms will be stringent and extensive compared to a fintech company is what's my understanding. To that extent, my knowledge allows me to understand this question.
Got it, sir.
Fintech is generally a service provider, means is a, you can say, aggregator for the NBFC, is a support to NBFC. NBFC is different, who is the original lender, but fintech is, just support to the NBFC.
Basically a channel to the NBFCs.
Yes.
Yeah.
Sure. So I think that was all from the questions front. I'll quickly pass it on to Anil sir for a vote of thanks.
Thank you, Tusharji. So now we come to an end. It was wonderful deliberation. Chinnaswamy sir has deliberated and enlightened all of us on various intricacies on this NBFC along with Rahul sir. Both the learned speaker has justified with their presentation, and we have gained a lot through your deliberation, sir. On behalf of Auditing and Assurance Standard Board, once again, I extend my heartiest thanks towards both the learned speakers for sparing their valuable time. In spite of having busy schedule in September, they have given us time for our members. Every time, whenever I call Chinnaswamy sir, I remember it is not a single time sir denied me. Nahi, is bar nahi. So every time, kisi na kisi tarah se, sir always give time to me, sir. Thank you so much from the core of my heart, sir, for such a wonderful deliberation.
Thank you. We equally thank WSP for giving the opportunity.
Thank you, sir. Thank you so much, Rahulji, for enlightening all our members about the same. I also thanks both the moderators, Tushar Kapoorji, as well as Ma'am Asta Gupta ji, for wonderfully deliberating today's webinar. And throughout the webinar, you are there and wonderfully handled the question answer session. I also thanks all the participants of today's webinar. Thank you very much, everyone. Thank you so much.
Thanks.
Thank you, everyone.
Thank you. Good evening.
Thank you.
Thank you, Rahulji.